Is it to say that economic developments, financial crisis, stock market collapse speculations, changes in gold prices could lose all of your investments? Or it can make you money. Financial Argument shares many experts' assessments and predictions about financial developments with you every day with current videos. All you have to do is follow the Financial Argument channel and subscribe to it. In order to support us, please do not forget to like our videos and comment on it with your own views. Finally, you can visit our website address, financialargument.net, and social media accounts for more financial news.
This video posted with permission. The financial and political opinions expressed in this video are not necessarily of Financial Argument or its staff. Opinions expressed in this video do not constitute personalized investment advice and should not be relied on for making investment decisions.
I'm Kenneth Emenduri, and I have the pleasure of interviewing right now Peter Hugg of Kitco. Now, if you've ever Googled the gold price or silver price or a number of other metals on the internet, you've probably come across Kitco, and they're just an authority in the precious metal space. And I have the pleasure to be interviewing Peter Hugg, Director of Global Trade for Kitco Metals, Inc. And he's been involved with the precious metals industry since 1974. And he's just an authority. And I'm happy to have him on. Peter, thanks for coming on the show with me today.
It's a pleasure to be here, Ken.
Well, let's start off here. The markets seem to be reacting on trade war fears, and then, it goes down on trade war fears, goes up on trade war optimism. It really seems like it's just news of the day, really, what the markets are going to do. So I'd like to get your thoughts on where we are right now in regards to the market, and what do you make of this current situation in regards to equities?
Well, if we look, if we step back a little bit and look back over, say, the last year, we were looking at gold about a year ago at in the mid 1300s, and it was at that point we put out a market sort of press release indicating that we needed gold to get over that 1365 level, which it had tested about 4 or 5 times over the past couple of years, to generate a technical momentum that would finally take gold back over 1400. When that level failed, we turned decidedly bearish on the market. And again, when I say bearish, we envisioned a downtrend with blips in between that downtrend. So for traders, there were a myriad of opportunities to trade this market over the past year and a half. But what basically caused the initial sell-off, and that continues to sort of play in the background, is the divergence in interest rate policy between the central bank of the U.S., the Fed, and the central bank in Europe, the ECB. The Fed has been on a tightening regiment now for almost 2 years. They've got 7 rate hikes behind them. There's still indications that they may go at least once, if not twice, this year. Whereas the ECB, Mario Draghi, has come out and said that the EU is probably not going to be looking at tightening until at least the earliest spring of 2019. So we've had an interest rate differential in favor of the U.S., which has created massive flows into the U.S. dollar, and a stronger dollar is generally negative for the commodities. So that sort of set the bearish tone on the market. The most recent issues that have surfaced are the issues with Turkey. Their currency has been pummeled over the past few months, and there is major exposure to Turkish loans from the perspective of the ECB. The European banks have major exposure to Turkey on their balance sheet. So there is some contagion risk there, which is then also now transformed money moving into the dollar and and also into the U.S. equity market, actually as a safe haven play against these issues that may surface in the European banking system. And most people think that that should be an immediate uplift for gold. But if you go back and you look at the 2008 scenario, when the financial crisis first began, gold actually dropped about 20%. And because money flowed into the U.S. dollar as the initial safe haven play, the U.S. dollar and the Japanese yen. So that tends to be the initial reaction. And then following that, the Federal Reserve dropped interest rates to zero, which basically crashed the dollar, and that caused gold to move up from the 2008 level to the high in 2011. I think we're looking at a similar scenario now. The initial reaction is a move into the U.S. dollar, which is putting pressure on gold and basically the entire commodity group, which is bringing it down. But I suspect that the Fed is going to be looking at that very carefully in September, and it wouldn't surprise me if they started to step back from their tightening policy and at a minimum stay neutral in just to see how these events unfold, both with Turkey, but also with the issues with the trade war with China, and also they've got the geopolitical risks of Iran and North Korea on the back of their minds.
Yeah, so many variables really across the geopolitical spectrum here. And, you know, we always talk about the potential for a black swan event. And I think it's interesting with what's going on with Turkey, because it was kind of fueled by this pastor in Turkey. And it really wasn't anything that had to do economically, but because of this tension that happened because of the pastor and what they deemed to be a threat, and Turkey and in the U.S., the way they're handling this, it's definitely impacting countries financially in a very big way. And, you know, no one would have predicted that could have potentially happened, but it's exposing the volatility of some of these markets with something, you know, really out of left field. So, I mean, what are we looking at here with just the instability of the situation? So many unknown variables that can really disrupt the markets.
Well, I mean, the other issue that when you roll it into something more on an economic macro basis is most emerging market debt, and so if you look at the South American countries, Argentina, you look at even Brazil, and then now you look at Turkey. I mean, almost all of their debt is denominated in U.S. dollars, and you have U.S. interest rates going up, so their servicing on that debt is causing them extreme pain. And and the Fed wants to go even further, so there is some serious risks on that sort of emerging market debt that could develop at any time. And there's these issues that have been out there over the past couple of years really haven't gone away. They've sort of been glossed over with the rally in the U.S. stock market and some of the rallies in the Asian markets, like the Japanese market. But the underlying risks to the economy and potential sort of ignition points have always been there. The problem is that the initial reaction is when you have these types of volatility events, people try to raise liquidity. And in most cases, they raise liquidity by selling their commodity positions. But that generally is a forerunner of the markets looking to bottom. And if they can't get a hold of these issues, and I just don't see, the issues are a myriad of issues out there. Even if you add just the U.S. debt to it, which is going to be another $1 trillion this year, there is going to come a time when you're going to see a significant rise again in the precious metals. So in the interim, should you be buying the precious metals? And again, when somebody asks me that question, Ken, I really ask them what their motivation is. Now, if you're a trader, you've had ample opportunities of making money in this market over the past 2 years. If you're an investor, this is certainly not the time to be liquidating your insurance position if you've been holding gold. You don't want to sell gold at the bottom. I mean, again, it's an insurance position. And if the balance of your portfolio is doing well, i.e. the stock market, your 10% position in gold that may be down 10%, so you're down 1% on your insurance position, shouldn't be something to worry about and lose sleep over, because the balance of your portfolio is doing well. But should that black swan event occur, that 10% position in gold is going to give you at least some protection on the balance of your portfolio.
Yeah, absolutely. And I'm looking at a chart of gold right now, and it's rough. In 2016, 5-year chart, you just see this massive spike off the low, from the beginning of the year, and it happened so fast. And I think for a lot of investors, they didn't have time to get in. And when they did get in, it pulled back on them.
Yeah.
And it pulled back quickly. And then sure enough, it slowly crept back up during 2017. And then when we did have that optimism once again, when it did start to look like things were turning around, here we are again at 1178 as I do this interview here. So I feel like there's a lot of disheartened investors in precious metals right now because of even just the way it's traded, because of the way people have got in and then watched it pull back. And so that's one of the things that I think has been difficult on the community.
Well, I would agree with you again, but it's the psychology of what you go in with. And, unfortunately, a lot of analysts or we'll call them pundits or, whatever word you want to use for the so-called experts. And obviously I'm also part of that group. They've come out over the years, and I mean, having traded this market since 74, come out with a number and say, hold 10%. Some people are a little bit more extreme and say hold 60, 70% of your assets in gold, which I consider absolutely ludicrous. But even at a 10% level in gold, gold is not something that is like, this special thing. It's a commodity. And holding a 10% position in gold should be treated the same way that you would look at the rest of your portfolio, whether you're holding Apple stock or whether you're holding 10-year bonds or whether you're holding real estate. It's not generally something when you make an investment that you just buy and just forget about. I mean, normally you look at your investments, you recalibrate your investments. Sometimes you'll move out of mid caps into large caps. Sometimes you'll move into, you'll move your weighting more into bonds as opposed to equities. So, it's an active role that you should be responsible for in your portfolio. Now, gold being part of that portfolio needs to be looked at as well. So if you look at a 10% allocation of your portfolio in gold, and you bought gold, I'll just give you the 2008, 2011 example. And you bought gold in 2008 at $700. In 2011, it was at $1,900. Now, when you looked at your portfolio, I would bet that 10% position in gold was probably now closer to 17%. Now, at that level, you have to sell 7% of your gold because your goal was to hold a 10% insurance position. Vice versa, if you unfortunately bought in at the high in 2011 at 1925, and then in 2016 it got down to 1,060, your position was probably 4% of your portfolio. At that point, you have to buy 6%. So you go in with the mentality, I want to maintain a 10% position. But if you recalibrate it, you'll tend to liquidate your gold or your excess gold as the market moves higher, and you'll be buying more gold as the market goes lower with the same parameter of always having that 10% insurance position.
Yeah, no, that's a powerful thing. I've heard a few people talk about that, and it's definitely something that I would suggest people do. I know going back to market psychology, in our most recent example of one of the greatest bull markets of my lifetime, probably in the last 100 years, the Bitcoin bull market we saw in 2017, people were more than happy to be 100% in cryptocurrency, the big enthusiasts of cryptocurrency, but in the moment of strength. Now, of course, when it goes back down, it's like, oh, now the prudence starts to kick in. But in the moment when we're on top of the world with cryptocurrency or the trend, it feels good to say, oh, I'm 50% in this, I'm 75% in this. But then, of course, when it starts to really turn around, then it's like, oh, well, now we got to be prudent on this. And I just I want to bring these subjects to the table. I want people to understand market psychology and how markets can wash and rinse investors if you don't get in front of the emotional aspect of the movements, because it can be difficult. It can be a very difficult thing. And you can look at a chart and say, hey, wow, look at it went straight up, but not have anything to show for it because you didn't position yourself in it. And so I think it's important to have these conversations and discuss this. Now, in the same vein of discussion, the mining shares have been a big disappointment for people. leveraged downside at this point. You have gold moving down, and then you have leveraged downside, or if you have obviously to the upside, you have that leveraged upside, which is the positive thing. So
Correct.
let's talk about that. Let's talk about the mining sector a little bit and your thoughts on, what you see going on in this space.
Well, again, when I go to conferences, there's generally a mining component to most precious metals conferences, and really what I see at these conferences are, again, I'll call them the professionals that really, are basically hyping, penny stocks, junior mining companies, and I just don't play in that game. I mean, if sort of a rule of thumb that I've learned over the past 40 years in this business is that if you buy 10 junior miners, you can pretty much bet that 8 of them will go to zero, and you might make some money on one of them, and one you'll hit a home run on. Now, in the context of a major bull market in metals, you could pretty much throw a dart against the board and you'll make money on every mining stock you buy, because basically that's just a momentum play, but it's not a value play. So if I'm in the mining sector, what I'm looking for is I'm looking for relatively mature companies, and they can still be juniors, but mature companies that are at least at production levels and are generating at least positive cash flow. That then to me gives me some comfort level that they can weather a downturn in the prices of the commodities. But if I'm looking at the mining sector, some of the better mining companies out there are not actually miners. I mean, they're royalty companies. I mean, if you look at Wheaton Precious Metals, an extremely good silver streamer, and they're now into gold streaming as well. If you look at Franco-Nevada, excellent management. I've known these guys since the early 80s. I mean, those are the type of companies that I would be more inclined to invest in as opposed to taking a shot on a junior. I think I'd have more success going to a casino and playing blackjack, where my odds are at least 49% that I'm going to win, as opposed to buying a junior that has leased some land next to somebody that's drilling, and they run out of cash. They've got to dilute their stock. They keep coming to the market for cash. So in these types of environments, I'd stay away from the juniors. Once this market bottoms and you have a comfort level that it's close to bottoming, if you can get a junior that's got good cash reserves, there I might be interested in taking a shot. But again, that would be very speculative. So again, not a matter of my age. I've been doing this ever since I was in my 20s. My tendency is to play more the seniors and the royalty companies.
So everyone's wanting to ask this question. We're waiting for the big move, okay, in precious metals, and I know that's $1 million question, right? When is the epic moonshot going to take place? And I know there's no crystal ball on this, but what are your thoughts on this? We saw this happen in different bull markets. We've seen it happen with equities, where you do have those unstoppable bull markets that take place. We saw it with cryptocurrencies, and different trends that happen. But it just seems so far away because of the beatdown we've seen with precious metals over the last few years. We're conditioned to think it's almost impossible now. So what are your thoughts on this? Are we close to something happening like this? And when it happens, what could it potentially look like?
I'm going to have to say, be careful what you wish for. I mean, quite frankly, I'm not wishing for gold at $2,000 an ounce, because gold at $2,000 an ounce indicates to me there's going to be some serious issues. I mean, there could be a housing market collapse, there could be an equity market collapse. So what are you wishing for? I mean, again, if you're a trader, you can get in and out of this market. But, for somebody, again, with your allocation, let's say at 10% of your portfolio, if you want gold to go to $2,000 an ounce, you'll do well on that 10%, but your other 90% is going to be at serious risk. So, I look at gold as, hold a little bit of gold as part of your portfolio, as a balanced portfolio. It's not something that, unless you put everything on the table, and that's a major risk. If you're a trader, that's a different story. You can be in and out of this market literally on a daily basis. I mean, buying gold on Wednesday morning would have been a phenomenal trade, because again, if you're a trader, depending on size, but I mean, gold's up $25 from the low, silver's up some 50 cents from the low. So you can trade and make money. But if you're sitting there on your couch saying, well, I got 10% in gold, I can't wait till it gets to $2,000 an ounce, you might not be happy with what you're wishing for, because that other 90% is going to take a serious hit.
Yeah, it's powerful. And I guess it really brings some perspective. And it's going to really depend on how people are positioned currently. If you are largely dependent on the U.S. stock market and you do see a major correction and you're hoping for a small percentage of your portfolio that is in gold, let's say, to go up, that could be in the net more of a problem. So definitely, yeah. Peter, I want to give you an opportunity here to share some closing thoughts and to share with our audience, what you see going forward in 2018, and how to prepare prudently for what you see coming.
Again, you can't just give an answer that would basically cover, sort of everybody's needs. I mean, you sort of learn this. It's, it's sort of investing 101 when, when I took the securities course back in 1982, and then took the commodities course. I mean, the first thing you learn in the securities course is when you're giving advice to a client, you need to look at, first of all, their risk parameters, their age, their tolerance for loss. So just to give a blanket statement of what to do is difficult, because somebody that's, retiring or getting close to retirement, I would claw back my my exposure to the equity market and be more balanced with maybe a higher balance in the fixed income side. If you're 20, you can take more risk, because you've still got 40 years of earnings ahead of you that that you can make up if you're wrong. So it really depends on where you are. I think that the market has some potential real hurdles now, other than the immediate hurdles, which is potentially the Turkish crisis. And there is some issues also with the Italian banks. Their balance sheets aren't looking too well, too healthy either. And potentially something with North Korea, something with Iran. If you sort of ignore that, I mean, the next sort of hurdle we need to get over, if you believe this economic recovery is going to continue, is that the Republicans are going to need to maintain their majority in the government. And, that is now a big question mark. We've got the midterm elections coming up in November. So, that's only 2.5, 3 months away. And, that could change the balance of power in the government. And if that happens, all of a sudden you've got a lame duck president for 2 years. And then nothing more happens. Now, what does that do to the economic recovery? Maybe that slows it down. And now all of a sudden you don't have this kind of push of spending money that Trump has been doing, even though he blamed Obama for it, to keep this economy revving. So there's a number of potential headwinds in the immediate future. So in that context, I'd be a little wary, and I would probably, again, depending on your age group, be a bit more orientated towards holding a larger cash position than I would. So let's say you're in your 20s, your cash position probably should never be more than 20%. You should be almost fully invested. But I would bring that back maybe to 65%. If you're in your retirement age, or getting into your 60s, and you've got 50% in equities, I'd probably bring that back to 30 and put the other 20% in fixed income, just to get through this sort of next 3 months. And then from there, reassess. And if everything looks rosy again, yeah, you may have missed a 5% move in the equity market, but you're not going to have been hammered. And then you can get back in and reinvest.
Well, we'll definitely be keeping an eye on the way things play out here. And yeah, stay prudent, everybody. Peter, thanks for coming on Crush the Street. If people want to learn more about you, the work you do, and where they can find your work, please let them know where they can go and what they'll find.
Okay, the one thing I wanted to mention, and again, I'm extremely transparent, and I never try to scare people into doing anything, but One thing that I like about Kitco, and I've worked for a number of companies and consulted for a number of precious metals companies over the years, is that Kitco offers a service that is really quite rare for a precious metals dealer. I mean, if you go to most sites where that you have retail precious metals dealers, I mean, they're selling product, they're hyping product, they're saying that, you know, whatever they're saying, they're trying to generate volume and trying to get people to engage in the market. The thing about Kitco is if you go to the kitco.com site, and I tend to write a commentary, not every day because it only makes sense if there's a reason to write the commentary, and I write it focused towards traders, not long-term investors. But if you go to kitco.com, you'll notice that there's 30, 40 commentaries daily, and they're by a variety of people in the industry, whether they're in the mining side or whether they're in the precious metal side. And some of them are bearish, some of them are bullish. So they're not always saying, the world's coming to an end, buy gold. And they give very good insights as to why they think the market is going to move one way or another. So if you're going to get into the metals market, I think the first thing you should do is understand it and learn about the market. And there I would strongly recommend, you go to kitco.com and just read the commentaries. And you'll notice that they're balanced, and they give different views on why things may happen. So now now you're educated. Now, once you then decide that one analyst or another is the one you think is correct, you can then take action. And you don't need to take the action with Kitco. You can go to your broker, you can go to another precious metals dealer, but at least you've taken the time to understand why you're making the trade, as opposed to your neighbor saying to you, oh, I just bought gold, I think it's cool, or I think it's going to $3,000 an ounce, and you buy it because your neighbor told you. So, you need to think for yourself, you need to educate yourself, and then make an informed decision. And that's where I think Kitco.com is miles ahead of the other dealers, because they do